In 1886, Carl Benz filed a patent for a machine he called the motor wagon. It was 3 wheels, a single-cylinder engine, and a steering tiller that looked like it belonged on a canal boat. Nobody wanted it. His wife, Bertha, took one without permission and drove 100 kilometers across Germany to prove it worked. That act of defiance launched one of the most dominant brands in the history of capitalism. 140 years later, the heirs to that legacy handed the keys to their company to Beijing, one joint venture at a time, and they did it while believing every single year that they were winning. Today, China's BAIC Group is Mercedes' single largest shareholder, holding 9.98% of the company. Li Shufu, chairman of Geely, sits just behind them at 9.69%. Together, 2 Chinese entities control nearly a fifth of the company Carl Benz built. Operating profits fell 57% in 2025 to €5.8 billion, the worst performance since the COVID era. Net profit was nearly halved, dropping to €5.33 billion. The 3-pointed star still sits on the hood, but the people who own the most of it are not German. The story really begins around 2010. China's middle class was growing by tens of millions of people every year, and those people wanted one thing above almost anything else: a Mercedes badge on the back of their car. In Chinese culture, the brand was not just transport. It was a signal, a declaration that you had arrived. Sales in China went from a rounding error to the engine of the entire company's growth. By the early 2000s, China was already the single largest market Mercedes had on Earth. By 2022, China accounted for 37% of Mercedes-Benz's total vehicle sales globally. Nearly 4 in every 10 cars the company sold on the planet were going to Chinese buyers. The revenue contribution was just as significant, and the board in Stuttgart could see it in every quarterly report. China was not a market anymore. It was a dependency. And like every dependency, it felt magnificent at first. The executives were not stupid people. They knew the risks of putting so many eggs in one basket, but the numbers kept growing, and growing numbers have a way of making risk look theoretical. When a market is delivering that volume, you do not question the terms of the deal. You protect it, you invest in it, you redesign your products around it. And quietly, without ever making a single decision that felt catastrophic, Mercedes began to change. Here is something the financial press rarely explains clearly. To sell cars in China at scale, foreign automakers do not just open a factory. They cannot. The Chinese government requires them to form a joint venture with a local state-connected partner. The split is typically 50-50. And to operate that venture, the foreign company must share its technology, its manufacturing processes, and in practice, its institutional knowledge with its Chinese partner. Mercedes chose BAIC, the Beijing Automotive Industry Group, a state-owned enterprise with deep ties to the government. The joint venture became Beijing-Benz Automotive, known as BBAC. At its peak, BBAC became Mercedes' largest passenger car production base outside Germany, responsible for roughly 30% of the company's global output. Think about that figure for a moment. 30% of everything Mercedes made worldwide ran through a factory where the Chinese government's partner had equal standing. The blueprints went in, the manufacturing expertise went in, the supplier relationships went in. In exchange, Mercedes got access to 1 billion consumers and record profits. It looked like a fair trade. It was not. If you're watching this and you invest in any Western company with significant China exposure, this next part is built for you. Subscribe now, because what comes next is the part the annual reports never quite explain. While most of the financial world was focused on the usual noise, a quiet transaction was being completed in the secondary market that would permanently alter the ownership of one of Europe's most iconic companies. Li Shufu, the chairman of Geely and China's largest private automaker, had spent months quietly accumulating shares in Daimler, the parent company of Mercedes-Benz. He did not announce his intentions. He did not approach the board. He did not ask permission. He used a holding company called Tenacieux 3 Prospect Investment Limited to buy a 9.69% stake, worth approximately $9 billion. When the announcement finally landed, Mercedes had a new major shareholder. Nobody in Stuttgart had seen it coming. The German reaction was a mix of alarm and forced diplomacy. Li Shufu's stated goal was access to EV technology and autonomous driving research. He wanted what Mercedes knew. The purchase of nearly 10% of the company was, in effect, a seat at the table. Not enough to control decisions, but enough to observe, to influence, and to ensure that the conversations happening inside one of the world's great engineering companies were visible to a Chinese competitor. The board welcomed him as a long-term investor. Li Shufu's move created a problem for another Chinese player who had far more to lose. BAIC Group, the state-owned partner inside the BAIC joint venture, had been watching Geely accumulate its stake. BAIC operated the factories. BAIC had government relationships. BAIC had spent years building its position inside the Mercedes ecosystem. And now a private Chinese competitor had just become a major shareholder. In July 2019, BAIC Group acquired 5% of Daimler. In December 2021, it increased its stake to 9.98%, surpassing Geely to become the largest single shareholder in the company. The move was deliberate and precise. BAIC was not acting as a passive investor. It was a state enterprise answering a strategic priority. The Chinese Communist Party had watched a private company gain a foothold in Mercedes. The state was not going to be outmaneuvered. Today, the two largest individual shareholders of Mercedes-Benz Group are both Chinese. BAIC holds 9.98% and Li Shufu holds 9.69%. The board in Stuttgart found itself caught between two Chinese entities with competing motivations, both with significant voting rights, both with deep financial stakes in the outcome of every major decision the company makes. That is not a partnership. That is a geopolitical tug-of-war, and Mercedes is the rope. Stuttgart has an engineering culture that borders on religious. Mercedes engineers argue about suspension geometry, the way theologians argue about scripture. The Autobahn is not just a road to a German car company. It is a test environment, a philosophy, a benchmark for what a vehicle must do at its absolute limit. For 100 years, that culture produced cars that other manufacturers used as the reference point. Then the Chinese consumer entered the equation. Chinese luxury car buyers, particularly in first-tier cities like Beijing and Shanghai, are not buying cars to drive. They are buying cars to be driven in. The back seat is what matters. Legroom matters. Massage seats matter. The 12-inch screen in the headrest matters. The way the car feels when it accelerates from a standstill in city traffic, that matters. Cornering at 200 km per hour on an open road does not matter at all. Mercedes began designing China-specific long wheelbase versions of the C-Class, E-Class, and GLC, extending the rear passenger compartment specifically for Chinese consumers. The cars got longer. The suspension got softer. The software interfaces got more elaborate. The engineering priorities shifted from the driver to the passenger, from the road to the cabin. Mercedes was no longer asking what a car should do. It was asking what a Chinese executive in the back of a car in a Beijing traffic jam should feel. That is a different question. And answering it consistently, year after year, does something to a company's identity that is very difficult to reverse. By the mid-2000s, the market dependency had become a technology dependency. Mercedes needed to compete in China on software and digital features, not just on engineering. Chinese consumers expected connected cars, AI assistants, and over-the-air updates. The German software team in Stuttgart was not fast enough, so the solution was logical, in isolation, build the capability in China. Mercedes opened two state-of-the-art R&D centers of global scale, one in Beijing and one in Shanghai. The Shanghai facility focused specifically on vehicle software and digitalization. The Chinese R&D team grew to over 2,000 experts, becoming the most comprehensive Mercedes research operation outside Germany, with innovations from the Chinese team influencing global development at Mercedes headquarters in Stuttgart. Read that again carefully. Technology developed inside China by engineers operating inside the joint venture framework was flowing back to Germany and shaping the company's global products. The direction of knowledge transfer had reversed. Mercedes invested more than 100 billion yuan with its Chinese partners since 2014. Each billion moved the center of gravity a little further east. Each R&D center established inside China brought the company's most valuable intellectual property closer to the people who had the most to gain from accessing it. The future of Mercedes-Benz was being built in Beijing. The question nobody asked loudly enough was who would own that future. The reckoning arrived faster than anyone in Stuttgart expected. Chinese EV manufacturers had been building quietly for a decade. BYD and Xiaomi were not just making cheaper cars, they were making better cars, at least by the standards of what Chinese consumers had decided they wanted. Superior software, longer range, faster charging, and features that Mercedes simply could not match at any comparable price point. Mercedes China sales tumbled 27% in the third quarter of 2025 alone, hitting their lowest level in almost a decade. The collapse in China dragged global shipments down 12% in the same period. Sales of fully electric Mercedes models fell by nearly a quarter in 2024, as Chinese manufacturers seized market share not just domestically, but in Europe as well. The EQ range, Mercedes' electric lineup, was rejected by the very market it was partially designed for. Chinese consumers looked at the EQE and the EQA and compared them against a BYD Han or a Xiaomi SU7. The BYD costs half as much and comes with better software. Xiaomi offered autonomous driving features that Mercedes could not legally activate in China because its mapping technology was not locally certified. The German badge no longer carried enough weight to close that gap. The golden goose had stopped laying eggs. The financial data from Stuttgart tells the story with a precision that no executive statement can soften. In 2025, Mercedes-Benz Group revenue fell 9.2% to €132.2 billion. Reported operating profit dropped 57.2% to €5.82 billion, well below analyst expectations of $6.6 billion. This was the company's weakest performance since the pandemic. China sales collapsed 27% as BYD and Xiaomi undercut the German carmaker on price and technology. The company is cutting up to 30,000 jobs and targeting €5 billion in savings by 2027. The target-adjusted return on sales for the cars division is between 3 and 5% for 2026, with no return to double-digit margins expected before 2027. A 3 to 5% margin is not a luxury brand. That is an assembler. That is a company putting components together and hoping the logo justifies the price, and the logo increasingly does not. In December 2025, the Mercedes star was quietly removed from the factory gate of the BAIC joint venture plant in Beijing's Shunyi district. The plant ceased production entirely. More than 3,000 workers went home. The star that Carl Benz's wife drove across Germany to prove would survive is now negotiating its retreat from the market it was most dependent on. Mercedes-Benz is not a cautionary tale about a bad company. It is a cautionary tale about a rational company making rational decisions, one quarter at a time, until the cumulative weight of those decisions built a cage they could not get out of. Every step made sense in isolation. The joint venture made sense. The R&D investment made sense. The product localization made sense. The problem was systemic. When your largest market is also run by a state that defines the terms of your participation, you do not have a market relationship. You have a landlord. Apple generates an estimated 20% of its revenue in China. Nike manufactures a substantial portion of its products there. Dozens of pharmaceutical companies have transferred formulation knowledge to Chinese partners under similar joint venture pressure. They are all watching what is happening to Mercedes with something they will not say publicly: recognition. The lesson is not that China is the enemy. The lesson is that any dependency deep enough to compromise your strategic decisions is not a partnership. It is leverage, held by the other side. Mercedes spent 15 years building the most profitable trap in automotive history, and the people who built the trap were not in Stuttgart. They were in Beijing, and they were patient. If this video gave you a new way to think about capital, geopolitics, and the real cost of market access, subscribe to Low Volume Capital. This is the kind of story the financial media moves too fast to tell. We do not.